So, I don't know. In our previous conversation or two, you told me you don't know much about real estate, but you're really interested in the asset class. And so I thought we'd start out with a little primer on, real estate investing, the types of investing you can do, and then migrate into the type of investing that we do and why we do it. Okay. So, basically, the basics are there's four types. I just wrote a blog post about this week. There are four types of real estate investments. There's core plus, value add, and opportunistic. And so and it goes from less risk to more risk. So the core plus is going to be a class A, maybe a single tenant occupancy Burger King, or out in the parking lot of a mall. You just got one tenant inhabiting the building, and they're on a long-term lease with rent escalators in it, and it's a bond. Retired people like those types of deals. They pay about 5 to 8% a year. They're really safe. They're really secure. But you're not going to make a lot of upside on the back end. You're just going to hang on to it for cash flow. The other extreme is, development deals where you're doing ground up development. There's a lot of risk involved. There's a lot of things that can go sideways on the deal for you. And it's a big boys game. The pro formas for these things are pages and pages and pages long. The people who do it are very, very experienced developers. When you see a tower go up in downtown Seattle, those are some very experienced developers putting that all together, and a lot of the stuff's in-house, so they're controlling their cost structure. We do value add deals, which we think is a real sweet spot, where you can buy an asset at below replacement cost and then renovate the asset so that you're pushing the NOI north and creating value where none existed before. And and then 2 years after we buy it, we're generally doing our cash out refi, handing all that money back to our investors, and then holding it to season the cash flow for the last 2 or 3 years, and we'll sell it at the back end for a profit. So it's known as a forced appreciation model, where you're literally trying to force the value of that thing north. And so it's an intense kind of in construction project. A lot of our projects entail, about 18,000 a door in renovation work. And what we're trying to do is buy these beat down assets at a very opportunistic price. This one in particular, we bought at a discount to the marketplace. And then we're going to push that way north. And that's why the profits on this one are so good, because we already have a 15% profit baked in as soon as we ink it. And then, then we do the value add. So that's why this one performs so well. I mean, the IRR on this one legitimately is going to be north of 25%. It's a very profitable deal. It's our most profitable deal of all time. And we're going to see a tsunami of these opportunities this year, because a lot of operators are in trouble. So, and we've got a pretty established footprint down there in Houston. Banks are calling us directly and offering these deals to us. They're just saying, do you want this? We'll give it to you for the face value of the note. Of course, we counter. It's like, well, we'll take a 15% discount on that note, and we want you to bring some equity to the deal. So going to be some really interesting conversations here in the next 6 to 9 months. There's a window of opportunity that we're trying to pursue in the next 6 to 9 months. When we offered on this one, we had put out 75 LOIs, letters of intent, to get this one. We started the raise on it 5 or 6 weeks ago. Since then, we have filled our pipeline with $500 million worth of deals. And so we're looking at a significant number of opportunities and trying to figure out how the hell do we raise all this capital. But that's a different problem. So that's the basic business model. And then the way we do it, Corey, is we have a vertically integrated company. So we're not just the deal sponsor. We also have our own property management company called Greenline Management. And within that are both the leasing agents and the technicians who spend all their time on site. And then we have our turn guys. So it's about 60-40, leasing and turn guys. And we do all that to control our cost. So everything in our whole business model is designed to control expenses and lock them down so that, we don't get whacked with, labor bumps or supply chain problems. We're able to predict with pretty good, a surety that, we know what the expense side of the ledger is going to look like in any one of our deals.
Is that vertical part also include the construction part, the 18,000
Yes,
that you mentioned? Okay.
Yeah. Not only does it include that, but we control our supply chain from India and China. So we're, Port of Houston's the largest port on the Gulf Coast. And so we're just getting this stuff shipped to us in containers. And then we have a 20,000 square foot warehouse there in Houston, and drivers and a warehouse manager. And so the drivers go get it and haul it to the warehouse, and then it's all cataloged by the warehouse manager. And then, when we need it, we go get it. So, when we order doors, we order 1,000 at a time. We order all of our countertops, slab countertops, we're getting for like $50 a slab. I mean, it's just a really significant cost savings over the local marketplace.
Well, I'm doing a huge remodel. Maybe I can buy some of your stuff.
A lot of it's just builder granite, so I'm not sure it's what you'd want to necessarily put in a high-end kitchen. But I don't know if you looked at the OM, but I mean, we even put glass vessel sinks in all of our bathrooms.
Yeah.
And this is a C-class deal.
Yeah.
So what we're trying to create, Corey, is we want to have the best product in the marketplace. So what we're trying to do is command market plus 10% on our rents. And all of our deals are underwritten to the base case rents. But, believe me, there's another column there of our upside rents. And in fact, I was just penciling another deal, and I was looking at what the delta was between base and upside. It's stunning. $25 a door in rent creates a lot of money, a lot of value. So, so we're always we're very conservative on underwriting. We would never underwrite the, upside, but we're aware of what it is, and we're going to go shoot for it. But on a base case, this deal is penciling at like 22, 23. And I don't know if you looked at the rents in the offering memorandum I sent you. The current ownership is actually well over market on some of their rents, which poses an interesting, not dilemma, but I had to present the case. Normally what you look for is the delta between where you're raising rents to from where you're bringing them, and then you have what's called loss to lease. So you're trying to capture that loss to lease in your underwriting. But because all those rents are above market, there's no loss to lease. There's actually a giving back. So what we did is we underwrote the deal to market, meaning we lowered rents on a lot of units down to market and underwrote it there. It still cranks out a 22 IRR, but I know I'm going to keep the rents up here. So that's why I was saying, we know this is our best performing deal of all time. It would be recklessly irresponsible of me to underwrite to those current rents. I can't do it. So we kind of went out and did a very serious rent survey of the marketplace and brought all those rents down in our underwriting. But we're going to leave them, we're going to renovate them and re-rent them, and who the hell knows where we're going to lease those at, it's a bit of an oddball deal, but it's profitable. So, so let me address risk mitigation, because I know that's of a concern to you. The fact that our entire business model is premised on controlling the expense side of the ledger is one of the ways in which we really try to protect your downside. We don't have surprises that way. We control our supply chain. We know exactly what it's going to cost to renovate our units. And we're legitimately renovating these things for half of what anybody else can do them for because all our labor is in house. You know, we're paying them a W-2, and what we're doing is we're eliminating the profit line from the contractor and the profit line from the asset manager. So, you know, normally in their budget, there's a P&L, right? You know, so that just goes away because it's in house. The other way that we control your downside is we only do fixed rate debt. So we don't do floaters. We did do bridge debt up to 15, 16 months ago. Market's a different world now. And even then, when we were doing it, we were buying a rate cap. And so that would guarantee the, you know, the top side of the interest rate. Now we're doing bank debt. And I know my partners are shopping the debt right now. And they're getting close to locking that down. But we're not going to have a floating rate, which is where a lot of these operators got in trouble. You know, they just had, for God knows what reason, they went in with a floating rate, and it's just stupid. You know, I've never done that. You know,
Yeah.
so you know, interest rates went up. They couldn't service their debt. They, you know, the operator of this deal bought this deal in 2018 for 45 million plus its capital stack. We're paying 40 million for it. And our capital stack runs to about 58 million. This guy evaporated $22 million on this. All his investors lost all their money. And it's just because he did like 3 of the classic things wrong. He wasn't vertically integrated. He went through 2 or 3 management companies while he owned the property. The pandemic hit him. He had tenants in there he couldn't evict, and we're not paying rent. His asset manager, you know, his managers were only so motivated to do anything about it. And look, we ran into the pandemic as well, and we had tenants that weren't paying, and we had one deal where it was hard for us to pay distributions. I guarantee you, we got those tenants out of there. We were highly motivated to get them out of there, and you know, 125 of those units all started to have electrical problems. Like the power went out in those units, and they had no choice but to vacate the units. You know, and that's us flipping the breakers in the, you know, electrical vault and telling them to get the fuck out of my deal if you're not going to pay your rent.
Yeah.
You know, so, you know, we're pretty aggressive about managing this. We understand very viscerally what it means to not bring that income in and what that can do to a deal. Guy who's got a third-party manager, they're only so motivated to work so hard.
Yeah.
So we do, you know, the whole of our company is really premised on, you know, protecting your downside, which is, you know, the big organization. We have 125 people on our payroll now. So it's all designed to kind of keep it under control, keep it going forward.
So is that the biggest risk once you get up and running? If, for instance, we have economy has a turn for the worse with all these rate hikes and all these sort of discussions and expectations, whether or not some tsunami or tidal wave is going to hit this economy at some point as a result of this rate shock and we go into a tailspin recession. I would imagine that's the biggest risk, is tenants basically losing their jobs and saying we can't pay.
Well, okay, so then you got to look at this phenomenon. We've had 3, essentially our 4th major economic event here in 13 years. Mm-hmm. What do you think that's done to housing production in this country?
It has, my understanding is that it has reduced it.
Yeah, it has. You can drop a pin anywhere in this country and there is a housing shortage.
Yeah.
And so what you have is, and look, population keeps growing, household formation keeps occurring, people still have kids. Yeah. And just because we have these major economic events doesn't mean that doesn't keep going forward. So you have, I think we're probably 5 to 6 million units of housing. That's a conservative estimate behind schedule right now. certainly there's 3 to 4 million of single family units that we're behind schedule on, and just as many apartments. And in 2022, it was a record year for apartment production, and we're still way behind the curve.
So what you're saying is that the demand is going to be there. It's a matter of basically
That's right.
evicting the non-paying tenants so you can get the paying tenants in there.
That's right. Now also look at the market that we're in. We only invest in, well, we own 2 up in Oklahoma City. I've got a little side hustle in a small town in Mississippi that, I regret bringing on, but it's a hugely profitable deal. But the vast majority of our portfolio is right there in Houston. And we keep it inside the outer loop. And this one is in the toniest zip code in all of Houston. That's the Beverly Hills of Houston that we are landing in. In fact, the address is Beverly Hills Street. I didn't realize that until long after I started marketing the deal.
Yeah.
So it's a really good zip code.
Yeah.
That area is the 17th largest office district in the country. It's bigger than Pittsburgh and Denver. So there's plenty of worker bees in that market. So, what you look for in this game is job growth. Job growth drives rent growth. And when you have, and what's going on now is you should look at, let me share my screen with you here. How do I do that? Share screen. I want to show you.
So did you say Houston is where most of the investments, most of the deals are in Houston? Is that right?
Yeah, that's exactly right. Yeah.
So are you concerned about basically being subjected to the microeconomic climate of Houston as opposed to diversifying your investment across many geographic areas so that you can?
That's an interesting question, and the answer is no.
No.
And we've debated that. I've looked at it for years. Here's what I can tell you. I have friends who are invested in lots of communities across the country. That is a nightmare portfolio to manage.
Yeah.
You cannot understand the nuances of every community and the ups and downs of that economy.
Yeah.
Whereas where you go, deep in a certain community, you're going to understand it, all the nuances really well. You're going to have all your, supplier relationships totally locked in. And look, Houston's like the 3rd or 4th largest city in the country and 2nd largest apartment market. It is the anchor of what's known as the Texas Triangle. If you know anything about that, you can read about it starting on page 46. I talk all about it. There it is. All right. This is all designed to answer your question. Okay. What's really interesting about Houston is it is massively rebounded since the bottom of the pandemic. It went up, from like a negative 6% to almost 5% on the employment forecast. But what's really interesting about Houston is it added 400,000 jobs since 2020. And its unemployment rate at that point was like almost 8%. They've added 400,000 jobs and their unemployment rate has dropped to 3.5%. So they added all these bodies and the unemployment rate still dropped. So what you've got going on in Houston is wage growth, massive wage growth. If our guys get a 50 cent an hour offer higher than what we're paying them, they're gone. They'll pack their toolboxes and leave. That's that's kind of that crowd. So we go through a lot of employee retention exercises to make sure they stick with us. But you've got all these, workforce housing folks with a growing income with all this money in their pocket. So, there's plenty of demand for units down there.
Yeah.
There's a lot of, the economic forces have really aligned. And what's really interesting about the Texas Triangle, they're going to create 15 million jobs there in the next 30 years. And there's just no way they can keep up with all that demand.
Yeah.
So if you own there, you're golden.
Yeah. And I would imagine that the hardest period was at the trough for the 2020 and in the COVID era, period. And it sounds like you did okay during that period, right?
Well, that's the point I was going to make is, you're worried about a future economic event. Look at the historical record.
Yeah.
And we just went through what is generally considered the major economic event of the last 100 years.
Yeah.
And we did okay.
That makes sense. Okay.
So yeah, I would say, read this last section. I put it in there for a reason. I'm a big picture guy. I like looking at the landscape from 30,000 feet to understand kind of the environment I'm playing in. The business model can be, drag and drop anyway, but you got to have the environment in place where it makes sense. And I settle in on you. I live in the Puget Sound. I can't wait I have one deal up here and I can't wait to lose this thing. Government up here is so invasive, so blue. State government just voted down 2 measures where, the progressives in Seattle went to the state legislature and they're trying to pass, statewide rent control. And it's a part of our state constitution. You can't do rent control, but they are trying every year to pass rent control up here. And it's already hard enough for us to build product, but you pass that and that's just a disaster. That is just a disaster in terms of housing production in the Puget Sound. You're going to see rents just go right through the roof. I mean, the demand is going to be nuts. So, the other thing I'll tell you is we only invest in red states, where the playing field is level and government stays out of my business. The biggest threat to multifamily housing is government interference. And so, Texas leaves us alone. It's you're seeing a lot of product being renovated down in Houston. The market's doing its thing like it should.
Interesting. Yeah. Yeah. Yeah, that's all really good, interesting information. And I appreciate you taking me through it. Definitely helps me become a little more comfortable with the whole thing. And frankly, as I think I mentioned to you before, I appreciate you originally sending me your references. I did talk to almost all of them. And as you can imagine, trust and confidence goes a long way. And they all spoke, quite highly of your diligence and, the risk management that you guys do and the success you've had so far. So again, thanks for this. This definitely helps as well. So what is the yeah.
If you'd like, I can bring my partner Josh on the call. He's sitting there right now. And we can do a roundtable here. He can talk to you at depth about the numbers and the underwriting. If you want to get a greater insight into that.
Yeah, I would welcome that. I would certainly welcome that. Are you or Josh coming down to San Diego anytime soon, or is that canceled?
I'm going to be down there in May again. I have a conference I'm speaking at.
Okay.
I was supposed to be down there now, but Lynn's out on the couch recovering. So, but let me, you don't mind, he's sitting there. He'll gladly join the call. So let me do one thing here. I'm not the best at Zoom, so bear with me.
I'm not too good at it myself. Yes.
So I just thought I'd run through how we underwrite deals. A lot of these templates are very similar. You have an inputs page where you're inputting, all of your labor assumptions, your debt assumptions, and, interest rate, amortization, that kind of stuff. And then, we crank out a monthly budget. Let me back out. You can see, it is quite a lengthy analysis of the monthly income. And then here we translate that into what it looks like annualized. And then, we'll get into the, this slide is more for presentation purposes, but it's kind of the pro forma And then this is where the meat and potatoes happens. This is where we're doing, our returns calculations. It's all said and done, we have two types of LPs on this deal, anybody over 1 million, or under 1 million, and then folks over 1 million. The returns are very similar. You can see for the, under 1 million crowd is 21.43, over 1 million is 22.15. The returns are going to be the same, except for the fact, if you know anything about finance, there's time value of money, right?
Yeah.
The B class shares, that's a 10 pref. For anybody over 1 million, they're getting a 10 pref, which means they're getting a 10% dividend. And just because they're getting their money back faster means they're going to get a little bit higher on the IRR. The other thing to know on our deals is that certainly the first 2 years in that cash out refi, that is a return of capital, not a return on capital, which means it's a tax-free event. So there is a business model to investing with us that I kind of articulate to everybody, and that is, if you are disciplined and can keep deploying through a 2-year cycle, because we tend to refi after 2 years on our deals. We target 5% of the units every month to be renovated, and we are religious about that. So that, after 100 months or 20 months, we've turned 100% of the units. We start teeing up a refi so that by, end of year 2, we're doing a refi. We're going to give you all that money back. And then what we're going to have is a deal sitting there waiting for you to just redeploy that money. What you're doing is taking a single dollar of your investment and buying 2 shares of stock in 2 different deals. And that is how you turbocharge your returns. You can create some serious wealth, over 5 years just by constantly redeploying and recycling your money and getting into a velocity of money concept. I've created a pretty healthy balance sheet for myself doing that very thing. I went through a divorce in 2008 and 9, was almost bankrupt, and I now have an 8-figure balance sheet following that model. So that's hang on. He's not able to join us. He's saying his spouse is kill him if he joined us.
That's okay. Perhaps we can do it some other time, or
he's saying he'd happy to jump on a call with you tomorrow if you'd like. So
yeah, perhaps, I would certainly appreciate that. I'd love to get into what you just described a little bit more granularly.
Yeah.
Perhaps I can do that with him as well, because that's sort of what intrigues me is understanding the dynamics of being able to generate those kind of returns. And look, my situation is that I have a lot of focus, a lot of eggs in one basket, which is my trading with my options, which is what I know and what I'm, what I do. And I've, as you know, want to diversify into real estate. And so this could become all along, I have expressed to you that my hope and my goal is to, for these incremental investments to be literally just seeds to sort of build a relationship with you guys, and hopefully be able to come in and eventually perhaps I can be in that category of over 1 million with you guys on an annual basis. I'd love to be able to get there with you. For me, it's just a matter of history, track record.
Yep.
Building. I'm by nature, having been in the past an attorney for almost 20 years. I'm by nature cautious and not impulsive, and skeptical, if you will.
You're not gonna hurt
a person. It takes time for me to be, especially when it comes to money. We're on the right track. That's all I can tell you. I really appreciate this meeting, and I hope to stay on the right track.
Yeah, look, Josh and I are both Michigan graduates. We both went to engineering school. I switched over to architecture. I got a few more years on him, but we, there's nothing more analytical than an engineer when it comes to the real estate deal. So, we're really, we vet this stuff out pretty hard.
Yeah.
And try to cover all the contingencies. That's what I'll tell you. We have, very expensive legal and accounting help. And so we're in the midst of like pumping out 1,000 K1s right now. It's April is just, right around the corner is killing us.
Yeah.
But we've tried to be, I mean, there are two ways to do a deal, the right way and the wrong way. We'd rather do it the right way, and it takes a long time and a lot of experience to learn how to do these things correctly. And what you do is, Josh and I both started our career, he did a 14 unit and then I did a different 14 unit. And then we just kind of leapfrogged up. And now we're doing these, massive deals. But you build, I guess is kind of what I'm saying. You just build on the experience of the previous deal. And it's a really interesting business if you like to learn stuff.
Yeah.
And that's why I like it. It's really interesting, but it also has a social component to it. 40 years ago when I wrote my essay to architecture school, I wrote about workforce housing and affordable housing. I've just always been an advocate of that. And I've been a housing architect my entire career. I mean, I've done a lot of single family detached. I've done a lot of multifamily. I've designed condos and apartments. I've renovated a lot of stuff. But at the core, I believe in the mission of what we're doing, which is to, kind of put a quality product out into the marketplace for, the people who can't afford to buy a house. Yeah. And down there in Houston, that's a lot of people with, the first generation immigrants.
Yeah.
And it's quite meaningful to walk around a site and they're coming up to me and tears in their eyes, wondering when they're going to be able to get one of the upgraded units, and they're so happy to have that done. I'm not a flaming idealist by any stretch of the imagination, but there is a social mission of what we do, and we feel pretty good about that. And it keeps us grounded, humbled, and a lot of our certainly our leasing staff, they're all Hispanic and first generation, second generation immigrants. So yeah, it's not all about making money. And I mean, if that's all it was, I'd be bored out of my mind. I wouldn't do it. I mean, I don't need to take this kind of, the brain damage we go through. It's not worth it. Yeah. I mean, I'll go lie on a beach in Costa Rica and be done. So,
yeah.
So, anyways, that's my little
soapbox. It's always good to have that deeper meaning behind what you do. It definitely is what makes you passionate, and I think that's an honorable goal, and that you guys do this.
I will say there are too many guys out there doing this who don't have that as part of their business model. You should see some of the shitholes we come across. It is disgusting.
Yeah. I have no doubt that's the case. I have no doubt that's the case, and you should. You should feel a great amount of satisfaction from bringing about that sort of increase in value in people's lives and what you're doing. So that's all, I think, additive, no doubt about it. I appreciate that.
Well, I don't know if you had a chance to go through our OM yet.
Your what?
The offering memorandum.
I think I skimmed through it.
I just want to show you one thing because I'm proud of it. There it is.
Yeah, I did skim through it.
Let's see where. This is what we do. All right, these are kind of the before photographs.
Yeah.
And here's what we do. I mean, we're running crown molding in a C-class deal with
nice.
chair rail and all new base and luxury vinyl plank flooring, designer lighting, tile tub surround, glass vessel sink.
So nice.
Next year,
I love it. No, this is actually
this is one of my side. This is the building I still own up here. All of these balconies were rotted down to about 1.5 inches. The joists were just completely rotted. I had to cut all those balconies off those buildings. And I had 8 pallets of 2x10s delivered to the site. And I hired guys who were 6'4" and taller. And they had to reach back into the joist bays with palm nailers and nail these new joists on the building. And we rebuilt all those balconies and put metal railings on them and a fluid applied membrane. That's a 50-year balcony. It'll be fun. It'll be there in 50 years.
Wow.
I also put an 80 mil cap sheet on this roof in February in Seattle. So yeah, we do some pretty deep dives on these structures, and always have. I build for a living, so I'm not afraid to kind of roll my sleeves up.
Yeah. Yeah, no, I can appreciate that. Those are really strong, good images. So let's do this. What's my timeline to I know the deadline had I think you said
if you want to come in, we'll let you in, but you do have to. What I'm going to suggest is Josh agreed to jump on a call with us tomorrow. What time works for you? And then he can kind of run through all the numbers in excruciating, painstaking detail for you.
Yeah, if you don't mind, if I can play by ear tomorrow. Since Sunday we have some family things going on, but I'm anticipating I'll be open later in the afternoon. If I don't know if Monday afternoon works for you guys. If not, I think I can make myself available tomorrow.
Yeah, the deadline is like now.
Yeah.
Candidly, we've been raising 5-6 weeks, and I twisted our other partner George. I twisted his arm to keep your slot open.
Okay.
I put you down for 100. So I don't want to see you get squeezed out of this one.
Yeah. I appreciate that, and I am inclined to move forward and do the 100. I would probably tell you, yeah, I'd like to have a chat with Josh tomorrow as well.
Okay.
Afternoon. I think that'd be good. So let's do that, and then yeah. So I can.
All right, I'll just let him know sometime in the afternoon. As you get a sense of what time, can you just text me and I'll firm it up with him?
Yeah, I will. It's going to be probably after 3 p.m. Between 3 and 5:30, around that time frame.
That's West Coast time, right?
Yeah, West Coast. Okay.
And I meant to ask, what part of San Diego are you in?
Rancho Santa Fe.
Oh, you told me that. I know where that is. Yeah, that's nice up there.
Yeah. This is a home I purchased a little over 6 months ago, and it'll be my last home because it finally found the one that had all the elements we were looking for. So,
good for you.
Yeah. So when you come down to San Diego, perhaps if you have some time, I can have you come over and sit down on the patio, and we can, have a drink and chat a little bit,
Sure.
and meet in person. So
I'd love to.
Yeah. So that'd be great. We should coordinate that. Okay. So I won't keep you much longer on a Saturday afternoon. I thank you very much. I will text you tomorrow to coordinate a time.
Okay.
For me and Josh to hop on a quick call and sort of have him give me his presentation. And yeah, sounds good.
All right, cool.
Yeah.
Good to meet you, Corey. I'll send you a link to the recording of this.
Please do. Thank you so much.
Okay. All right. Thanks a lot.
Bye-bye.
All right. See ya.